Hey guys, welcome back to a brand new video. I'm RexFinance, and today we're going to be talking about a $1 stock that is going to go parabolic. Now, that could be parabolic up or it could be parabolic down. I, for one, believe that this is going to be parabolic up because I own 10,000 shares of this company. By the way, my brother is a high school geometry teacher. He would love the fact I use the word parabolic in one of my videos. I'm going to have to send him the link to this. But the stock I'm talking about today is Workhorse. Yes, it is tried and true on this YouTube channel. If we go to the 5-year chart, it's painful. I purchased the stock long ago at like $1.70 or something like that. And yes, I rode it all the way up to $40 per share before selling it at $20 per share. It would have been great to sell it at $40 per share, but I still 20x'd my investment. Unfortunately, something very fundamentally went wrong with the company where they didn't win a $6.3 billion contract with the USPS, United States Postal Service that is. So the stock has basically been cratering ever since then, but just recently I decided to reopen my position as the company's kind of priced for bankruptcy right now, and I don't think the company's going to go bankrupt, and I'll explain to you why that is in this video. But it's important to note that this is part 2 of my Workhorse due diligence. You don't have to click off this video and go watch part 1 right now. Just I'll click the eye in the top right-hand corner, open it up in a new tab after you watch this video. Go check that one out if you're curious about the company. And lastly, I know for a fact there's going to be a lot of people that are new to my channel that are watching me for the first time on this video. Do me a favor and hit the subscribe button. I appreciate you. If you aren't aware, Workhorse is a company that produces both electric drones and electric vehicles, and they focus on the delivery segment, electric delivery vehicles, as well as electric delivery drones. And the company has me extra excited right now because these vehicles are out in the wild right now. We had Joshua Goldman on LinkedIn post just recently that he saw a truck from Workhorse at the Home Delivery World USA. This truck exists. This is a working electric vehicle truck. We also have Morgan Olson putting refrigerated units on a Workhorse truck. Volta Air reefer units on a Workhorse truck. This is out there. You can buy this. And then just recently we got teased on LinkedIn from one of Workhorse's director of sales saying something's brewing down south. Stay tuned. A blurred out image of a guy working potentially in a truck. I don't know, but she says a press release is coming soon. It's been 2 weeks and we have not gotten a press release, but let's put all this excitement to the side for just a little bit and really analyze this company. So one thing I did make clear in part 1 of my Workhorse due diligence videos is that I would have zero issue selling out of my 10,000 shares if the company and the management team did not execute. And you know, the Q1 earnings release came out and I was ready to hit the sell button. They produced only 10 vehicles. They delivered only 10 vehicles in Q1. And to me, that just wasn't going to cut it. But I decided to give the management team a chance, listen to the conference call, read through the 10Q, the SEC filing, all that boring stuff that only a nerd like me enjoys doing. Yeah, I did all of that. And I've decided I'm actually ready to double down on my investment if Q2 results prove to be as good as the management team says they're going to be. But without further ado, let's go ahead and jump into this thing. Firstly, I want to start with the financials. The financials are the first thing I look at whenever I am looking, or whenever I'm trying to decide whether to invest in a new company or not. If they have bad financials, I stay the heck away, especially if it's a small cap company like Workhorse is. Workhorse has $79 million in cash, and they have no debt. That is huge for a company that's trying to make it out of the bottom and go to the top. So the balance sheet on this company is very, very strong. It gives me no cause for concern, other than the fact that the company is unprofitable. If we scroll down to the income statement, we can see that they had $1.7 million worth of sales based on those 10 deliveries they had last quarter, but they burned $5.3 million on cost of sales. The margin there is not very encouraging, and this is something I'm going to be watching very, very closely moving forward. However, the management team actually addressed this in the 10Q. This is the the tidbits you can pick up on if you actually take the time to read these SEC filings. On page 19 of the 10Q, under the heading Liquidity and Capital Resources, they say our annual cash burn increased during the period ended March 31st. However, we expect it to decrease overall for the period ending December 31st, 2023. That is this year, despite increased working capital requirements and R&D activities. So why would this be? Why does this make sense? Well, they gave us even more information in the earnings call. The CFO talks about it here where he says, no, I think at a truck contribution level, margins are positive, but positive gross margin will be a factor of volume as we start to cover the fixed cost. What the CFO is saying here is that they have positive contribution margin on every single vehicle they sell moving forward. Contribution margin is simply the sales revenue minus the variable cost that it took to build the vehicle. What this means is as the company increases their volume of production, they can cover more and more of the fixed costs in excess of the variable costs that are already covered. And as soon as they cover all of the fixed costs of the company then becomes profitable and they have net income. So Workhorse, although it's a penny stock, although there's risk, although they have negative gross margins currently, they're more than likely going to be profitable as a whole, as an entire company, sometime late next year, if I had to guess. And this is a very big deal when we start to talk about the cash burn of the company. December 31st of 2022, a quarter ago, the company had almost $100 million in cash, and they ended up with only $80 million in cash after Q1 of 2023, which means all in all, they burnt through $20 million in cash. But as they ramp up their production and deliveries, the revenues increase, their profits increase, and as a result, they burn less cash every single quarter. So the way I look at this is the company has at least 4 quarters of cash runway that they can exist as a company, that they can flirt with as a company before they get into trouble without any additional external financing. But talking about financing, I actually hate what the company is doing right now. During the 3 months ended March 31st, so during the first quarter of 2023, they issued 14.4 million shares under the ATM program for net proceeds of $18.6 million. This means they are selling more and more of their company at a lower and lower stock price. If we go back to the stock price chart of Workhorse, we can see during the first quarter of the year, the company's average stock price, I would say, was $1.50, maybe $1.70. They're selling more and more of their company at what I view as cheap prices via this ATM program. I am not a fan of that. I don't think there's any reason you would want to sell more of your company at a value that is undervalued. That's just, it seems like the market is just stealing Workhorse's money here. Now, I do understand why they're doing this. In today's market, small caps and mid caps in particular, companies don't have very many options for financing. You don't want to take out 8, 9, 10, 11, 12, 13% debt. That would be the end of your company as you know it if you are not anywhere close to profitability. But to give credit where credit's due, the CFO of the company is doing something very, very smart. With their $80 million in cash, they have that cash invested in a money market fund, essentially, where they actually had interest income of $550,000 during the quarter. That's kind of crazy to see an unprofitable company have interest income rather than interest expense. This CFO is running the company very, very well. It sucks that he has to be diluting shareholders via the ATM, and I sure as heck hope he hasn't been doing so as the share price has fallen near $1 or even less than that. 85 cents, I think, was our local low. But perhaps the biggest concern for me as an existing Workhorse shareholder is this $20 million in shares that are payable under the securities litigation settlement, where Workhorse is going to have to dilute $20 million worth of shares in order to pay the settlement from this huge lawsuit that took place after the company lost the USPS contract. With a current market cap of $200 million, that essentially means the company is going to dilute existing shareholders by another 10% of their value. That is not going to be fun, but after this is out of the way, it's one less thing we have to worry about as investors. Now, if you're an existing Workhorse shareholder, you may not agree with me, but I do think as a result of this, a reverse split of the stock is probably likely. Now, a reverse split is not near the death sentence that it's made out to be for a company. It's very, very simple. The company simply reduces the amount of shares outstanding in order to maintain listing requirements with the NASDAQ or the New York Stock Exchange, you name it. Just because a company goes through a reverse split doesn't mean it's a bad investment, doesn't mean it's going to zero. The only time that I get concerned is when a company chooses to actively dilute shareholders over and over and over again, which sinks their share price lower and lower and lower, where they then have to do another reverse split, and then they continue to dilute shareholders, and they do another reverse split, and it's just kind of a death sentence for shareholders. But personally, I don't think this is going to be the case with Workhorse for reasons I've already mentioned. Now, with all the financial jargon out of the way, let's go ahead and discuss the fundamentals of the company. Currently, they're shipping W4CC vehicles to customers, and production of these vehicles is ramping up to 5 units per day by the end of Q2. As I'm making this video, we're nearing the end of Q2, so I think it's safe to say that the company right now is producing and delivering around 5 vehicles per day. After only delivering 10 vehicles in Q1, it's easy to see how much bigger of a quarter this could end up being for Workhorse. And perhaps what's most exciting is the political push that basically every company in America is feeling, whether that be from the federal government or state government like in California, to purchase electric vehicles. For example, in California, next year already, in 2024, companies that purchase commercial vehicles, at least 9% of their purchase orders must be electric vehicles. And you can see how this percentage ramps up every single year, and California is not the only state doing this. We have California, Oregon, Washington, New Jersey, New York, Massachusetts, Vermont, Colorado, several more states in the process of doing this. And I think in the end, basically every state is going to push this agenda, whether you like the policy or not. That's not what this is about. Workhorse benefits from this pressure that companies feel. Workhorse is one of the only companies out there producing electric commercial vehicles. Most other companies have plans for 2025 and 2026 to finally start producing these electric commercial vehicles. And speaking of companies producing electric vehicles, CleanSpark has the foundational plants, warehouse, battery storage facilities, equipment, everything you need to be able to produce up to 10,000 vehicles a year by 2025 and 2026. There are very few, if any, other electric vehicle companies out there that can make that claim. This company doesn't have to retool a whole facility. They don't have to purchase any facilities or warehouses. They have done all of this already. Their expansion is complete. Now, I'm not saying they're not going to want to try and expand beyond this 10,000 vehicles a year number. I think that's inevitable, but as of right now, this company has the groundwork laid, unlike any other company in this space has. The most exciting tidbit that I got from the earnings call was this line by the CEO of Workhorse. He said, "So when I got here, UPS said, if you can't carry 8,000 pounds, quit talking to me." And now they're talking to us. If you didn't know, the prior management team under Workhorse had lots of purchase orders under their belt. They were in discussions with UPS, FedEx, WB Mason, USPS, basically every single delivery company out there Workhorse was talking to. Then this new legitimate management team came in and was honest about their vehicles. They weren't up to code. They weren't up to standard. They weren't making money on these vehicles they were trying to sell these companies. So they completely kind of had to cut ties with UPS and FedEx, etc. But now UPS is talking to Workhorse again. So I think it's likely that sometime in 2023, the company will announce a new purchase order from UPS. I think that is a given at this point. Now, speaking of purchase orders, we have some significant news coming out of the government, particularly can't say that word, particularly the Air Force's North Spark Defense Laboratory, based at Grand Forks Air Force Base in North Dakota. They are working to finalize their first purchase of one of Workhorse's Falcon drones and the suite of supporting systems that comes along with it. Workhorse qualified to sell to the United States Air Force. The Air Force is buying from Workhorse. That is no small feat. They talk about it even a little bit more here. We are about to secure our first purchase order for the Falcon from the U.S. government and are close to landing additional new orders for this tough-duty drone. This earnings call took place exactly 1 month ago from the day I'm recording this video on May 15th. We still don't have news about this purchase order. I think this press release is more than likely coming very, very soon. But it doesn't stop there. They also say we expect to earn additional significant work with the USDA towards the end of Q2. Workhorse is working directly with the government, which is a huge deal. Not only does the government's policies help push this electric vehicle agenda onto companies, but the company itself, Workhorse, is selling to the government itself. And I think it's only a matter of time before the government starts purchasing commercial vehicles from Workhorse rather than just their drones alone. And then we have this tidbit. Overall, we are pleased with our progress now and look forward to announcing additional appeals or government grants in the coming months. The government is looking to subsidize and finance Workhorse, giving them grants. It is so much easier to survive and thrive as a company if you have government purchase orders and the government is backing you. I feel like I could just talk all day about Workhorse and my research and due diligence on the company. There's just so much going on here, and I'm ultimately just willing to take this risk. I fully understand I could lose every single dollar I put into this company, but based on my hard work, my research, and due diligence, it's worth that risk to me. That does not mean it's worth the risk to you, so please do your own research. But right now, I want to show you my price target or valuation spreadsheet that I've made available to my paid monthly members down below. You can get access to this for not $500 a month like most memberships are, $5 a month. $5 a month, join my membership down below. Hit the join button or click the link to Patreon in the pinned comment. I would love to have you join our membership. We're having such a great time in there lately. But anyways, without further ado, let's go ahead and jump into this. So right off the rip, I should cover, I have the PE valuation and price target table blurred out, grayed out, whatever you want to say, because, well, ultimately right now the company is not profitable. And because they're not profitable and because they're probably more than a year out from being profitable, it's really hard to even come close to an accurate PE multiple, for example. So in this video, we're going to focus on a price to sales valuation, but as the company nears profitability, I will add in the PE valuation and probably do a discounted cash flow as well. At the top of this spreadsheet, I have 2022's actual revenue from the company of $5 million. In 2023, which is this year, analysts expect the company to have $85 million in revenue, and then next year in 2024, analysts expect the company to do $320 million in revenue. So you can really see easily how quickly this company is going to grow up. Now, for the next part, this was a little bit more difficult to piece together. If you don't agree with my numbers, if you don't agree with my units sold, my sales price, etc., you can change those numbers by downloading the spreadsheet to whatever you see fit, to whatever you see is more accurate than what I have in this spreadsheet. But right now, as it sits today, I have the company delivering 384 W4CC vehicles at a sales price of $150,000, which gives the company $57.6 million in revenue. The W750, which is going to go into production very, very soon, I have the company selling 100 units this year at $165,000, giving the company $16.5 million. The W56 is going to be the lifeblood of the company. I think this is going to deliver the company significant revenues and significant profits over time, but I don't see them selling as many units this year in 2023 as the next and the year after, especially because, well, the company has to ramp up production before they can produce hundreds of vehicles. But from the W56, I still expect the company to get around $14.5 million in revenue, which puts my revenue estimate for this year at $88.5 million. From here, I have an 8% margin on this revenue from the vehicles, which brings the vehicle's gross income to $7 million. I don't really know what to expect from the drone segment yet. I still think that is a little ways away as well. For now, I have $200,000 of revenue coming in for the Falcon drone, which is the drone the company is going to sell to the government. That number could very well be much higher than that. I will change that as we get more information, but I think the profit margin on the drones business is going to be much higher. I have a profit margin on every drone sold of around 20%. Which gives us $40,000 of drone gross income this year, and total revenue for the company of $88.65 million. I then took a guess based on previous years and said the company's going to have operating expenses of around $100 million, which brings operating income to negative $92, almost $93 million, and a net loss of $93 million. And a negative earnings per share of 42 cents. You can follow this price target spreadsheet through every single year. 2023 was what I just covered. 2024 is the same exact thing, and 2025 is the same exact thing as well. I have the company having a profit of around $7 million in 2025. Now, we will need to consider taxes to adjust this operating income to net income when the company becomes profitable, but because that's a few years out into the future, I can't really take a guess at what tax rates are going to be, so I'm leaving that be for now, and I have the company delivering positive EPS of 2 cents per share by 2025. I also think as the company delivers more and more vehicles, becomes more and more profitable based on volumes, that the price to sales multiple is going to increase every single year. This year, I have the price to sales multiple, which is average for the industry, of a 6, which would make the company in 2023, based on everything we know and my analysis, 120% undervalued. Now, in this, I have also considered 20% annual reoccurring share dilution. I don't see the company stopping their dilution anytime soon, but as we enter 2025, we will see, and again, I will adjust the spreadsheet as we get more and more information. Now, if you agree with my personal analysis and you believe the company will execute and deliver on all they've set out to do, we can also figure out, based on 2025 numbers, how much I believe the company is undervalued. Now, again, this is only if the company executes and makes it to 2025. So based on 2025 numbers, I believe Workhorse is undervalued by 1,986%. I believe the fair value of the company based on 2025, if they execute and deliver, is $22.54, which represents tremendous upside, obviously, from the dollar share price we're at currently. Now, again, I need to review. I am not a financial advisor. I do this in my free time. I have a passion for investing. I have my own personal risk tolerance that might be different from your personal risk tolerance. I very well could be wrong. Please do your own research and analysis and due diligence. Again, if you want access to this spreadsheet, just hit the join button down below, join my membership, join the Discord server, and you'll very easily be able to download this Excel spreadsheet. If you're new here, returning, and not yet subscribed, please hit the subscribe button down below. And with that, have a great rest of your day. 10 toes to the ground, chin up, peace out.